Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. First, with the end of the year coming, there are certain deadlines that you should be aware of every year from an investment and tax optimization perspective. There are also some elements to have top of mind as the new year begins, so January and February of the new year. These happen every year, so even if you're listening to this episode in, let's say, July 2030, this episode will still be relevant for you as these are things to think about and reevaluate every single year. Think of this episode as a checklist that you can use every year to help ensure that you aren't missing anything from an investment, tax, and government benefit optimization standpoint. For example, if you're getting the Canada Child Benefit, CCB, or maybe you're retired and you're getting GIS, the Guaranteed Income Supplement. Now, apart from the end of the year deadlines, I also find that December and early in the new year, like January and February, are a really good time to evaluate your finances, investments, and taxes for the new year. And the reason for this is that first, you have around 2 months from the start of the new year before the RRSP deadline. And what that is that essentially during those first 2 months of the year, you have the option of contributing to your RRSP and still have it count towards reducing your taxable income for the prior year. So you can have them count towards either the new year or the prior year. You get that option within the first 2 months of the year. Now, this is significant because let's say you evaluate your income for the year, you see how much you made, and you find out that a portion of your income is in a higher tax bracket. For example, let's pretend that you're $10,000 into the next higher tax bracket because of your income. Well, this means that the $10,000 will be taxed at a higher level than the rest of your income. So knowing this, you could put that $10,000 into your RRSP or FHSA if you're eligible, and that would reduce your income for tax purposes so that you are not getting taxed at that higher rate. And if you want to know what these tax brackets are, just Google Canada tax brackets, and the first result should be the page that tells you this on canada.ca, which is the official government website. Now, this is very significant and something that my wife and I did throughout our career before retiring. And so I suggest that you do this analysis before the first 2 months are up in the new year, because after that point, you won't be able to attribute your RRSP contributions to the previous tax year anymore. So let's say you put money into your RRSP in mid-March of 2025. Well, now that can only count towards your income in the year 2025. You can no longer apply that deduction to 2024. If this is confusing, then let me know and I can do a separate episode on this to help to explain in more detail. Another reason why it makes sense to do this financial analysis and self-reflection early in the year or in December of the previous year is that your personal taxes need to be filed by April the 30th. Now, what some people think is, oh, no rush, I've got until April 30th to get my finances in order, so I'll just call my accountant sometime in April and they'll do all my tax filing and my tax planning and they'll optimize everything, no problem. Now, before I explain why this is crazy talk, I first need to emphasize that tax filing and tax planning are not the same thing. So think of tax filing as more of an administrative type of project where you and the accountant are primarily trying to get the government everything that they need before the filing deadline. There's the filling out of the forms and doing the actual filing itself. Next, think of tax planning as a strategic type of project. It's where you are sitting down with your accountant, analyzing your finances and tax situation, and making a plan on how to pay the least amount of taxes and how to get the most government benefits and tax credits and deductions in the new year. In other words, so you have a plan on what should I be doing with my income, with my investments, with my spending to minimize the taxes that I pay and maximize the government benefits that I receive, like different tax credits and benefits like the Canada Child Benefit, so the CCB, OAS, GIS, etc. So tax planning is, I would say, more thinking, analysis, planning, and implementation, whereas tax filing is a bit more of on the administrative side where you're not being as strategic. You're just basically trying to get this project done, trying to get everything into the government on time. Now, many accountants will do some tax planning strategies while they are filing your taxes, but ideally, you want to have tax planning sessions with your accountant in addition to the tax filing project you give them so that you are being proactive in minimizing your tax and maximizing your benefits instead of being reactive where the year is already over and now you're just hoping that you qualify for some credits, some deductions, and some benefits. So you see kind of the difference, right? One is more planning. How can we qualify for this credit? How can we qualify for this benefit? How can we maximize it? These are the kinds of talks that you're having with your accountant, not when the deadline is quickly approaching, but way ahead of time so that you know how you should be managing things throughout the year so that when it is time to file your taxes, you already have your ducks in a row and you know that you've already been doing things in an efficient and correct fashion to, again, minimize your taxes and maximize those government benefits that you receive. Okay, so now that we know that distinction between tax filing, that being one project, and tax planning, that being a totally different project, let's go back to how some people think, oh, no rush, I've got until April 30th to get my finances in order. So again, I'll just call my accountant sometime in April, the same month that it's due, and they'll do all my tax filing and my tax planning, and they will also optimize everything. So hopefully I don't offend anyone by saying this, but I find that logic is hilarious. It's like, let me get this straight. This person is going to approach a tax professional during their busiest time of the year. The accountant is working crazy hours. They are exhausted. They are filing tax returns nonstop. And this person here, in this hypothetical example, but people like this do exist. I have met them. They're going to call them at this time when the accountant's just exhausted, again, overloaded, working nonstop. And they say, hey, Mr. Accountant or Miss Accountant, before you file my taxes this year, can you also meet with me several times for a strategic planning meeting and also do some thorough analysis outside of our meeting on my tax situation just to make sure that, everything is optimized. And then when you're done doing that for me, let's meet again to discuss what you found in your analysis and let's talk about how we can best implement it for my particular tax situation. So if a person does that, let's pretend you do this with your accountant in April, how high quality of a service do you think that person is going to get asking a good accountant to do this for them during the busiest time of the year for that account? That would be like asking me to do a financial plan with a tight deadline while my kids and I are sick with the flu and I'm trying to take care of them while barely functioning myself because I've got a fever too. I mean, you just won't get the highest quality of service from any professional when they are already stretched to the max. So early December is actually when I meet with my accountant to do this type of tax planning. And I actually asked him when is the best time for him to do this type of thorough tax planning and analysis. And that's what he told me. He told me, okay, Cornell, December is a good time. Let's do it then. So I advise you to do the same. Ask your accountant what is the best time for them. When are they the least busiest so that they can actually devote that proper amount of time to do the tax planning with you. Now, I like doing it in December because it is before some of the December 31st financial deadlines that I'll be discussing in a minute. And so this way, if my accountant has any recommendation that have to do with those December 31st deadlines, then I have time to implement them before December 31st, before the deadline. And so this is what I recommend to you as well. The other thing to think about is that even though the year is not over in December, and so you haven't gotten your T4 yet from your work yet, for example, you and the accountant can still predict pretty accurately what your income has been for the entire calendar year. You're basically just forecasting what you're going to earn in December, even though December is not over yet, which for most people, what the income you make, for example, in December will be the same as what you've earned in the previous month. So I find it's not a big deal that you are doing this tax planning analysis in December instead of after the year is fully complete. Because again, the account might start getting pretty busy once January comes around, like in my case. And again, I would rather do this with my account in December when they have lots of time than in January when they might start getting busy. I basically want to work with them when they are not rushed so that they can thoroughly do the tax planning with me. And that is what I advise you to do as well. So like I said, in my case, it's December. I do like December, but maybe your account, maybe it's November. Maybe they actually do think it's best to meet in January, and you can just make sure you manage those December 31st deadlines ahead of time. So there are different ways to do it, but my main point here is don't go to your accountant at the end of March or early April, because they're going to be crazy busy, because by that time, all the different slips have come into you. And so now they have everything they need to actually start filing taxes. And that's when things get crazy busy for them. Okay, so this is why you should care about all of this in this 3-month period of December, January, February. So in this example, that would be December 2024 and then January, February 2025. But again, you would want to do this every single year. Now, to kick things off, let's start by talking about the December 31st deadlines that you should be aware of. And again, if you're listening to this episode and it's already past December 31st, this is still relevant to you because you have to remember this for next year, okay? It's quite important. And I do apologize as well for not releasing this episode earlier in December. I actually had pneumonia. My daughter and wife also had it, so my voice was in no shape or form to be recording. I had a fever. It was horrible. So yeah, my apologies for releasing the episode so close to that December 31st deadline, but trust me, you did not want to hear my voice, and the fever was pretty intense. So next year I'll have to do this one much earlier, and hopefully I don't get really sick again. Okay, so let's talk about these deadlines, these December 31st deadlines. Again, keep these in mind for next year as well, and basically for all recurring years, because this is something that you need to think about. So the first thing we're going to tackle is the FHSA. So this is one of the most sensitive ones in terms of a December 31st deadline. And this task is for you and your partner to open an FHSA account if you are both eligible. So again, it's called the FHSA. FHSA stands for First Home Savings Account. And we could literally do an entire episode on this, as it is a registered plan, just like a TFSA and RRSP are registered plans. But the FHSA has its own rules. So we're not going to spend an hour right now talking about it. Otherwise, the episode is going to be multi-hours long. But let me know if you want me to cover it, and I can get some other experts on that as well on the show. But the bottom line is that if you are eligible, it is an extremely tax-efficient tax savings and investment vehicle. One, you can use it to reduce your taxable income for the year in the same way that an RRSP can. So I talked before about the different brackets and how maybe you're a little bit in the higher tax bracket. Well, you can use what you put in there to basically reduce your income so that you stay in the lower tax brackets. The other thing about it that I really like is that you can buy ETFs within it. So I'm an ETF index investor. That's what I do. FHSA lets you do that as well. You're not forced to sign up for some plan that's going to charge you really high MER fees, things of that nature. No, you can buy ETFs within it. You can invest within it just like you do within an RRSP or TFSA, for example. The money can be withdrawn tax-free when used towards your first home without any payback requirements. This is huge because think about it. You basically put money into it, so you get a tax deduction there because it reduces your income. So you benefit greatly from that alone. It's basically like an RRSP in that scenario. But if you are actually going to use that money towards your first home, and again, there are certain different rules, so go on the government website, check it out for the FHSA. There are certain rules you have to comply with, but if you fit those rules, then basically you can use that towards your first home without any sort of payback requirements. You don't have to pay it back, and you're not going to pay tax on it either. So really attractive vehicle to use, assuming you qualify for it. Now, another big thing here is that even if you don't end up buying a home, you can transfer the money to your RRSP without it affecting your RRSP contribution room. Now, that is huge. So between you and your partner, that can be an extra $80,000 in RRSP contribution room because you each get $40,000. So $40,000 each, total would be $80,000. That is a massive amount. Now, a big thing to remember, and this is a common misconception, you actually can qualify for it even if you owned a home in the past. So it's very easy to just look at the name and be like, oh, well, this is just for people that have never owned a home and they're doing it for the first time, because that's what the title of the actual account is. But under certain conditions, you can actually qualify for it even if you have owned a home in the past. There are certain rules you have to comply with, but it is possible. So just because you own a home in the past, it does not mean that you are automatically disqualified from it. So that, again, very huge, very important, because again, think of that $80,000 potentially an extra RRSP contribution room. I mean, that is massive, especially let's say you're self-employed, you just pay yourself dividends instead of salary. So you may have very little RRSP contribution to begin with. And so this is a really nice boost. Okay, So to learn more about it, just like I said, just Google FHSA and space Canada.ca. Canada.ca is the official government website. So FHSA, Canada.ca, Google that, and you can check out the government website there with all the details. I'm going to do an episode, I think, on this in the future, as it really is an amazing program that we do need to highlight. Let me know if you want me to do that. But again, there are certain rules and details that you need to look into. So if this is not on your radar, it definitely should be on your radar. You should at least look if you qualify. And what's really neat, another good strategy that you could use is, let's say you're a renter now, or you have some other sort of living arrangement where you don't actually own the home. Well, you could still apply for the FHSA and never actually use that money to buy a home. You could actually set it up, and the whole time you could just letting it go forward until you're able to convert it into your RRSP. And so in this way, it's not like you're forced to buy a home just because you have an FHSA. And it's like, oh, worst case scenario, it just gets added to your RSP and it does not affect your RSP contribution room. So, I mean, either way you benefit, even if you never actually end up buying a home. It's not like you get penalized because you open this account and then you change your mind and you don't want to buy a home anymore. So again, we'll go into this in more detail in a future episode, but just I want you to really have this on your radar, as it is a very, very powerful vehicle for you to use, especially for your kids as well. But even again, for grown-ups who maybe have owned a home before, you might still qualify. It really is quite amazing. Okay, so the reason that this is a very high priority and urgent, if you're eligible, is that in order to build contribution room within the FHSA, you have to actually open an account. So if you are listening to this and it's still December, open an account now if you qualify at your discount brokerage of choice, so that this way you and your partner will each get $8,000 in contribution room now, and then you'll get another $8,000 in contribution room on January 1st of the new year. And just as an aside, if you want to support the show, I do have a refer a friend link for the 2 discount brokerages that I currently use. The first one is Wealth Simple. So if you want to sign up there, that is over at buildwealthcanada.ca/wealthsimple, and you'll actually get some free money if you open an account through that link as well. And then the second brokerage that I use is Questrade, and the link for that, the refer a friend link, is buildwealthcanada.ca/bonus. So buildwealthcanada.ca/bonus for Questrade, and buildwealthcanada.ca/wealthsimple for Wealthsimple. So yeah, definitely, if you are going to sign up anyway, I appreciate if you use those links, as it helps keep the show going. But yeah, regardless of which brokerage you use, even if you don't use the ones I use and you don't use the refer a friend link, fine, I'm not mad. Just open up an FHSA account if you are eligible, because it is an extremely valuable account. And now a quick intermission to tell you about an additional free resource that you may find helpful. On this podcast, we often cover best practices that can not only help you now, but will also be relevant throughout your investment lifetime. But what if you also want an update on what is happening with your investments, the markets, and the economy right now? So to help me stay up to date on these topics, a great Canadian podcast that I listen to weekly is called Views from the Desk. They provide timely information for us Canadians on what is happening to our investments right now, as well as other key factors affecting us, like changes to our interest rates, our inflation, and regulatory changes that we should know about here in Canada. The podcast is hosted by BMO ETFs. I'm a huge fan of theirs. I own a lot of BMO ETFs myself, and it's a great resource for both new and existing ETF investors. I hope you check them out. All episodes are available for free in your favorite podcast player. Just search for Views from the Desk. All right, so the next item to be aware of when it comes to December 31st deadline, and again, this is not just for this year, this is for any year, so keep this in mind. Set a little reminder for yourself to think about this once the year end is approaching next year. Basically, it has to do with the RESP, so the Registered Education Saving Plan for your kids. And the question you want to ask yourself is, did I top up my RESP for my kids? Now, ideally, what you want to do for each of your kids is you want to put in $2,500 in per kid every single year. And this way, you get the maximum government grant of $500 per year for each of your kids. In other words, you set aside $2,500 for each of your kids' post-secondary education within your self-directed RESP. I highly recommend you do a self-directed one, again, through a discount brokerage, and then you get a free $500 for each kid automatically added to your RESP account, okay? So this one is literally a no-brainer because you're getting free money from the government just for saving for your kids' education. Now, the reason December 31st is relevant in this case is that let's say that you have previous years where you did not invest in your kids' RESP. Then you can catch up only one of those years every single year. So let me help explain this with an example. Let's say last year, I did not contribute to one of my kids' RESP at all. Well, that means that this year, I can put in $2,500 for this year and another $2,500 for last year. And so that means I'm going to get $1,000 in government grant money for that kid because I'm getting $500 for this year and $500 for the previous year. So I'm going to see $1,000 basically flowing for free into my account. But let's say that I did not contribute in a bunch of years before that, not just 1 year, but a whole bunch of years. Well, every year I can only catch up 1 year. So you basically, to maximize the grant, if I have missed years, I can only put in a maximum of $5,000 per year to make up for a missed year. So again, $2,500 will go for the current year, and you can do $2,500 for a previous missed year, but you can only do 1 year at a time. So if I missed, let's say 5 years, for example, I cannot just put in $12,500, for those 5 years that I missed. You can't just do all of that in 1 year. Those are the rules of the RESP. So because you can only catch up for one missed year at a time, you want to make that catch-up payment now before December 31st, because then when January 1st comes around, you will be able to make another catch-up payment for another missed year. In other words, by doing a catch-up payment before December 31st, you're essentially accelerating how fast you can do the catch-up payments, okay? So for instance, you could do $5,000 before December 31st, so that way you're paying for, in this case, 2024 plus one missed year. And then when January 1st comes around, you can put in another $2,500 for 2025. And if you still have another catch-up year left over, you can put in another $2,500 for another missed year. And so again, you can see how this way you can catch up much more quickly to basically maximize the grant money that you receive from the government when it comes to your RESP. And I will also do a public service announcement here. When it comes to RESP, there are certain companies, certain group plans, which have, again, this is like a whole tangent I can go on. So I'm just going to give you the really short version. But basically, long story short, is when it comes to your RESP, you should open up a family RESP. This is what I did, what I do. Do that in a discount brokerage. So again, I mentioned Wealthsimple, I mentioned Questrade, or whatever brokerage you use, just open up one there, a self-directed one. And then just what I personally do, I just buy an asset allocation ETF. So again, I buy ZEQT. That's literally all I do in these days. When it comes to my RESP, I just do ZEQT. I put that in there, and again, the rules are really good. They are not as restrictive as when you go with some of these group plans. You can Google it. There's tons of, again, I'm not saying they're all bad, but there are a lot of horror stories from people. I even have family that went through this where they got basically pretty ripped off. So you really want to be careful when it comes to RESPs. If you've heard bad things about it, it's probably because someone signed up for some of the sketchy group plans that are out there, and they basically, frankly, got ripped off. So again, not saying all of them are horrible. I'm not making blanket statements here. But again, what I personally do and what I strongly, strongly, strongly recommend that you do when it comes to your RESP is just open up a family RESP account within whatever discount brokerage you like to use. And then within that, you can just buy ETFs, buy an asset allocation ETF, and you're done. If you have questions about it, feel free to reach out. I can do another episode on it, but I'm not going to talk about it for an hour because I can go on a giant rant because there's, again, horror stories, lawsuits, whole shebang with some of these group plans that exist in Canada where the fees, the MERs are extremely high. If something doesn't go according to plan, like your kid decides not to go to post-secondary, there can be some major penalties that they impose on you, where you could even lose a good majority of the gains that you've earned in your RESP, even all gains I've even heard in some cases. So, I mean, again, I'll stop my rant, but just please be very, very careful about it. And if you're already signed up to one, again, be extremely careful, read the fine print. Again, can't recommend enough that you do a self-directed family RESP account. You just need one that can apply to all of your kids. It's really, really good. Okay, I'm going to move on. This is a really big one because it can literally save you thousands and thousands of dollars in gains. So, okay, I'll move on. But as you can tell, I'm really passionate about this particular one because it's a really easy landmine to step on, and it can cost you literally thousands of dollars and many, many years of growth. Okay, moving on. TFSA, we're going to get back on track here. TFSA, and the subject here is basically getting your room back. That's what I'm going to call the subtitle. The TFSA, getting your contribution room back. So when it comes to, again, how this impacts the December 31st deadline, why December 31st is relevant when it comes to your TFSA. And the thing that you should keep in mind is that you basically get your TFSA contribution room back in January 1st, okay? So I'm going to give you another example here. So let's say that you took $10,000 out to spend in your personal account this year. So let's pretend it's December 20th and it is 2024, okay? Well, when you did that, you now have to wait until January 1st of the next year for you to get that $10,000 in contribution room back in your TFSA, okay? So for example, if on July 1st, my TFSA is maxed out, and again, big thing is, let's pretend it's maxed out, you've been contributing to it, you've been maxing it out every year, now it's July 1st, your TFSA is maxed out, and you took out $10,000 out of it to spend just on whatever. If 3 months later, let's say I made some money at my job and I wanted to put the $10,000 back into my TFSA, well, I can't. If I do that, that will count as an over-contribution to my TFSA, and there are basically financial penalties for doing that. Because again, you were already maxed out on your TFSA, you took the money out, now you're trying to put it back in, but you were already maxed out. And so again, the government will see that as an over-contribution, and there's going to be penalties. But if I wait until January 1st of the next year, then at that point, I get that contribution room back, plus, so again, in this example, the $10,000, plus I get even more contribution room since every year the government gives us more. So in January 1st, I can basically put that $10,000 back without any penalty, plus whatever new contribution room the government gave us that year. And now when I checked today, 2025, that amount is an extra $7,000 in contribution room. So currently, with the way what the government has released, they're saying in 2025, we're all getting an extra $7,000 in contribution room. So again, this assumes that my TFSA was already maxed out to begin with, because let's say you took the $10,000 out and then a couple months later, you want to put $10,000 back in. Well, if you have $10,000 of contribution room still left, because let's say you have not been maxing it out every year, okay, then you're fine. You're still within your limits. But if you're already maxed out and you take money out and then you try to put it back before January 1st, that's going to count as an over-contribution, because again, you have to wait until January 1st before you get that contribution room back from whatever it is that you took out. Okay, so why does December 31st matter in this case? Well, because if it's December now, let's say, and you know that you want to take some money out of your TFSA soon, then you should do it now in December before the end of the year, because that way, starting January 1st, you get all that contribution room back. So ideally, what you don't want to do is you don't want to take out that money really early in the year, like January, for example, because now you have to wait almost an entire year to get that contribution room back. So for example, let's say I take that $10,000 out on December 1st. Well, I only have to wait a month to get that contribution room back and be able to put it back in. Versus if I took that money out on January 1st, well, now I have to wait pretty much an entire year before I get that contribution room back. So again, this is why it makes sense. If you know you're going to be taking money out of your TFSA anyway, then this is something to think about. All right, so the next item to think about when it comes to December 31st deadlines is the basic personal amount. So this is something to be aware of, again, before December 31st. And this is more so if you're retired or if you had a very low income year or you are not working. So the question that you want to ask yourself is, did I withdraw at least up to my basic personal amount for me and my partner? Now, the government can change this at any time, but currently that amount is $15,000 per person. So the basic personal amount is essentially the amount of income that you can earn tax-free in Canada. It is a non-refundable tax credit, so you want to make sure that you and your partner are at least generating $15,000 in income each, since you basically get to earn that much money tax-free. So for a couple that are both working, you are realistically going to exceed this amount. But where this comes into play is if you are retired, for example, since then you are living off your investments, and those investments can be taxed very favorably in different cases. So I know when my wife and I retired, one of the items on my checklist was to make sure that the income number that shows up on our tax returns, it should be at least $15,000 for the income, so that we take full advantage of this basic personal amount. Now, things can get more complicated when it comes to things like income splitting and spousal credits, things of that nature, or maybe you have your own corporation. So again, speak to your financial planner and or your tax account about that. But the bottom line is that you want to make sure that both you and your partner are getting this full amount every year as income, as it is tax-free income. So for example, let's say that you are early retired earning $0 in income. Well, maybe it makes sense to at least take out that $15,000 from your RRSP, since that will count as income. And this way you get to take out that $15,000 tax-free. Now, this can be huge since, for example, let's say you earn that money during your working years and you were in the highest tax bracket in Ontario. That means that because you put that money into your RRSP during your working years, when you're in the highest tax bracket, you did not have to pay the 53.53% tax on that income. That's what the tax is in Ontario in the highest tax bracket. And again, I still can't believe how high the tax can be, where if you're in that highest bracket, for every dollar you earn, the government is taking more than 50% of that in tax. But anyways, I digress. So now that you're in retirement, when you take that $15,000 out, if you have not used up your basic personal amount for the year yet, then you are now paying 0% tax on that $15,000 instead of the 53.53 in this example. So again, paying 0% tax instead of 53.53%. That's huge. So now I realize that this is an extreme example, but I think it really clearly shows the benefit of using something like an RRSP during your working years when you are in that higher tax bracket, and then taking that money out in retirement where you are in a lower tax bracket. To give a more common example, most people in retirement would be in the 20% tax bracket, which is the lowest tax bracket. So even, and again, that's what my wife and I are in. That's what most retirees are in that I talk to. So even in that scenario, that is a huge difference between paying over 53% tax if you're in the highest tax bracket versus just paying 20% tax on that money in retirement because you decided to use your RRSP. So, I mean, if you ever hear someone bad-mouthing an RRSP, frankly, they don't know all the details, because honestly, the RRSP is an absolutely incredible tool when it comes to tax optimizing your finances. Okay, it's worth mentioning too that since you get more tax credits in retirement, you can actually take out more than $15,000 in some cases. And keep in mind that things like money taken out of your TFSA don't count as income at all. Capital gains in your taxable account are taxed very favorably as well. Canadian dividends in your taxable account are also taxed very favorably. And so the big takeaway here is that even though $15,000 sounds like a very small amount per person that you can get tax-free, you can actually take out way more than that in actual dollars, since different types of income are taxed differently in Canada. So for example, you could take $15,000 out of your RSP. Yeah, that's going to count as income. But if you take another $20,000 out of your TFSA, well, that's not going to affect your taxes at all, because you can take out of your TFSA tax-free. So you just got an extra 20 grand without it affecting your taxes at all. So again, this is something to think about once you were kind of in that retirement phase, because different investments from different accounts are taxed differently. Especially in retirement, you can really have a lot of flexibility in which account you pull from to pay the lowest possible tax. All right, now for this next part, I did have several more items for you to keep in mind every year when doing your annual tax and investing optimization strategy session. But what I did is, in order for you to get a second opinion from another professional and to make sure that I didn't miss anything, and also since it's good to have more than one perspective on things like this, I reached out to a professional financial planner who is also the owner of a very high quality blog called unconventionalwisdom.ca. Make sure you put the .ca because .com is some other site. So unconventionalwisdom.ca. You've likely heard him on my podcast before. His name is Ed Rempel. I've interviewed him many times on my show, as well as at the Canadian Financial Summit. He's both a tax accountant and a financial planner. So what I like about his blog is that he doesn't just regurgitate what 10 other bloggers have already written. He actually does his own analysis using the literally decades of financial planning and tax experience that he has. So I thought he'd be a great fit to take this annual checklist that I use for my own finances, which is what I'm taking you through today, and see if he has anything to add. So again, you can check out his research and writing for free over at unconventionalwisdom.ca, or you can go to edrempel.com. Both of those sites will take you to the same place. He's not paying me to mention this or anything like that. I just know that he does really good quality content on financial planning and tax here in Canada. I read and I do watch his content on his blog and on YouTube regularly. And so I think he deserves a shout out, as I love geeking out on the research and content that he produces. Okay, so one of the first things I mentioned to add to my list, especially near the end of the year, is to work with a financial planner and giving them an estimate what your taxable income is for the year. So your paycheck and then your other income that you have. And really investigating what deductions do you have and what deductions are you eligible for. There could be some planning opportunities and some optimization opportunities when it comes to using dividends versus capital gains for the year, for example, especially if you are just above or below a tax bracket. There might also be some income splitting opportunities, he says, with your spouse. So basically, you do want your accountant or financial planner to do this type of analysis. So this speaks to kind of what I was talking about earlier, where when the accountant is not busy and when the financial planner is not swamped, that's when you want to have these strategic meetings to talk to them. Because again, like he just mentioned, there are certain circumstances where there could be some money saving, tax saving opportunities from a financial planning, taxation side. And so you do want to meet with a professional to see if there are any things that you can take advantage of. And he also did mention that for retirees, if their income is low, then determine if they should take money out of the RSP and how much they should take out of the RSP to stay within the low tax bracket. So again, if you're very low income, it makes sense probably to take money out of your RSP, but you don't want to take out too much because then you're going to jump in tax brackets. So that is a whole planning exercise that you should think about as well. Is, okay, what kind of income have I taken out already? Can I take out any more before jumping into the next tax bracket? Do I need any more? That kind of a thing. Okay, the next thing that I have on my list, and again, this is not a December 31st thing anymore. This is just general good best practices when you're doing your financial planning review for the year. So again, I recommend doing this January, February, or even December of the previous year. So basically go through this checklist to see if there are any optimizations that you should be doing with your portfolio. So one thing to look at to have on your checklist is what MER am I paying on my investment? So this is the fee that you pay on your investment. And I would very highly scrutinize anything that you're paying where you're getting charged over 0.2%. Okay, so 0.20%. If you're paying over that in MER on your investments, I would basically evaluate whether you are really getting value by paying more than that. And the reason I use 0.2% as this benchmark, what you should compare your investment fees to, is that asset allocation ETFs like ZEQT, which I think I already mentioned is one that I like, one that I buy, they charge 0.2%. So I use that as a benchmark because that is a very, very good product with a low fee that does a lot for you. So if you are paying more than that, there better be a good reason. They better be generating some crazy returns consistently for you after fees. This is the number that you want to compare your investments to from the fee side. Most mutual funds charge way more than this, and they underperform the market after fees. I mentioned before on the show, there's the SPIVA reports done by S&P. I've had them on the show before as well, where something like 90+% of these high fee mutual funds, they try to outperform the market. After fees are factored in, they underperform. You would have been much better off with an asset allocation ETF. Again, this has been proven over and over and over again, year after year after year. So again, if you are paying more than 0.2%, which is, I would say right now, even again, I prefer BMO, but there's other companies as well, like Vanguard, like iShares. The last time I checked, which was pretty recent, they also charge 0.2% on their fees on their asset allocation ETFs. So the fees are pretty much in line. BMO, iShares, and Vanguard are the three largest players in Canada when it comes to ETFs. They're all looking at each other to see what each one is charging. And so currently, at the time of this recording, they're all at 0.2% for their asset allocation ETFs. So again, that I would argue is all that you need in your portfolio for the majority of Canadians, unless you want to go crazy like me and just go nuts on the tax optimization side by doing a lot much more advanced, but also much more time consuming things, which again are only worth it if your portfolio is getting pretty high. But yeah, for most Canadians, I would say asset allocation ETFs are the key. So if you are paying more than 0.2%, there better be a good reason for it. You make sure you're actually getting some good value out of it. All right, so what I'll say about this is that overpaying here can literally affect your net worth long term by hundreds of thousands of dollars, literally. And I'm not exaggerating here. We've done lots of episodes on this already, so I'm not going to talk about this for an hour, but please look at this annually on your investments. So to put some actual dollars to it, to give you some actual examples, if I buy ZEQT, which is the BMO All Equity Asset Allocation ETF, this is what I use exclusively in my kids' family RESP account, and I hold a bunch in my corporate investment account too. And I suggest it to friends and family for the equity portion of their portfolio. So again, I find they're a very good example to use. This is the benchmark that I use. They charge 0.2%. So on $100,000, if let's say you invested $100,000 in ZEQT, that's $200 a year that you would be paying in your MER. Now, if you compare this to a high fee mutual fund in Canada, we have some of the highest mutual fund fees in the world. So if you research this, you'll see some at 2.5%. That's a normal thing that you will see if you start digging into this. So at 2.5%, that's $2,500 in fees per year that you'd be paying compared to the $200 a year that I'm paying on every $100,000 that I invest within ZEQT. Okay. So this is literally some of the lowest hanging fruit when it comes to optimizing your investments. And because these savings are automatically invested, so every dollar that you're not paying in fees, that dollar is automatically reinvested, right? Because it's staying as part of your investment. It's not getting withdrawn as a fee. So they compound over decades, which is why this one decision can literally affect your net worth by hundreds of thousands of dollars over your investment lifetime. I've done the math myself. I've seen it on my spreadsheets, and there are dozens and dozens of highly reputable sources that confirm the massive impact on these fees as well, how it actually can be definitely easily in the hundreds of thousands of dollars in savings if you switch from a high fee mutual fund to something like a ZEQT, where it's just total market index investing at a very low fee of 0.2%. Now, like I said, I did want to get a second opinion from another individual on the show. So I asked Ed what he thinks about this particular point on my annual checklist that I do when I review my investments every year. And he says that you have to ask yourself as well, if you are paying a higher MER or if you are paying higher fees in general, what are you getting for those fees? So for example, what happens with some Canadians is they have a financial planner and they pay them through an assets under management model. So what happens there is they pay a fee on the investments themselves. So they may pay something like 0.2%, but then they may pay, let's say, another 1% for that financial planning service. So if you have $1 million portfolio, you might be paying $10,000 on your investments, and that goes to the financial planning company. But for that, you might be getting some really high quality financial and tax planning. They might be helping you with your estate planning, with your insurance needs, like the whole shebang, essentially. And so what Ed emphasized is that, okay, it's great to just be a DIY investor and just pay that 0.2%, like with like something like ZEQT, and then you're done. Awesome. But he said, okay, there is also this other thing to think about where some people will just use a fee for service financial planner, where you're just paying a flat rate like you would an accountant or a lawyer for advice. What you're paying them is not based on how big your portfolio is. So that's one model. But the other model in Canada is the assets under management model. There are reputable companies in Canada that follow that particular model. But then again, the fees you pay are a percentage of your portfolio. So they can get quite large. And so in those cases, you have to ask yourself, is the value that I am getting worth the amount of money that I'm paying? Like again, if you have $1 million and you're paying 1%, which is a pretty common fee that they charge, okay, so you're paying $10K a year. Okay, what are you getting for that? Are they saving you at least $10,000 in taxes and different optimizations, things of that nature? If the answer is yes, then okay, maybe you keep going with them. If the answer is like, oh no, they met with me for they called me and we chatted for 10 minutes and they just told me to top up my RESP and that's all the value you're getting. Okay, then that is, I would say, obviously very bad value for the money that you're paying. So Ed did bring up a good point, how we shouldn't be so fixated on paying the lowest fees that we forget about everything else, because some people do pay for financial advice with a higher fee as a percentage. Okay, so just something to keep in mind. And now a quick message from one of our sponsors. There are so many opinions on how to invest your money today, but it can be hard to find credible voices to rely on in the world of finance and investing. One resource I turn to every week is the ETF Market Insights YouTube channel, led by today's episode sponsor, BMO ETFs. Market Insights brings in industry experts, and their weekly episodes cover the hottest themes like inflation, infrastructure, healthcare, and more. Tuning in helps me stay up to date on what's happening so I can be a smarter investor. And you can also submit your own ETF questions to be answered on the show. So do yourself a favor and subscribe on YouTube to ETF Market Insights, or visit etfmarketinsights.com so you can be notified when future episodes go live. Okay, the next thing to have on your checklist when you're evaluating your investments for the year is, did I underperform the market because I was being active trying to beat it? Okay, so once again, did I underperform the market because I was trying to beat it? If so, do you still think you should be an active investor? So put another way, if you are not just let's say, buying an asset allocation ETF and just buying the market, if you're not doing that because you say, hey, I think I can beat the returns that the asset allocation ETFs generate, I could just manage my own stock portfolio and pick the winning stocks and things of that nature. Okay, if that's your thesis or whatever, that you think you can do that, okay, great. But then evaluate every single year. Okay, I thought I could beat the market. I've been trying to beat the market all year. Did I actually beat the market? And make sure you're tracking this properly as well, because there's definitely been studies where people believe, especially like day traders, where they believe they are beating the market, but they are not. So look at that, because if that was your whole thing, was I can beat the market, but you look back and you're like, well, I've been trying to beat the market for the last 5 years, and only one of those years I actually beat the market, I actually would have been better off just getting an asset allocation ETF and being done with it, and then instead focusing my time on, let's say, earning more money at my job, or in starting a business or something like that. That would have been more lucrative, because here I am spending all this time micromanaging my investments, trying to beat the market, and I never even beat it anyway. So you would have been better off just buying the index. So that's something that you have to, I think, reflect on every year if you are an active investor. And a little variation of that is we see some of this with indexing. So even if someone is buying ETFs, just because you are buying an ETF doesn't automatically mean that you're a total market index investor, where you're just buying the whole market, and riding that. Because there are different ETFs. Some ETFs are actually active ETFs, where it's active investing, where there is speculation taking place. And so some people, they buy ETFs, but they will say, oh, I'm very bullish. So I think, let's say tech is going to do very well, or I think AI is underpriced, so I'm going to buy even more of that and have a bigger portion of my portfolio, let's say, towards AI or whatever the new hot thing is. And so instead of just going with market capped weights, just going total market index investing, instead, they'll actually place bets using certain ETFs. So they'll get like some AI only ETF, or it used to be like the pot stocks, where, okay, we're going to get an ETF that's just pot stocks, or things of that nature. So some people, they might not be picking individual stocks, but they are actively investing by speculating and buying ETFs that tilt their portfolio a certain way. So again, the same thing applies as with active investing, buying individual stocks, is you have to ask yourself, okay, here I am trying to beat the market by tilting my portfolio in certain ways by speculating. Have I actually been beating it? And if the answer is no, okay, then maybe you should reevaluate whether this is really a good use of your time, right? And so I would argue, like what I personally do is I just do total market index investing. I don't do any speculating. I don't tilt my portfolio one way or the other. I just do that. And then instead what I do is I spend my time focusing more on things that I really can control, that I can get good at, like the tax optimization, like what we're talking about today, right? So which accounts do I withdraw from? Which investment should I have in which account? Which tax credits am I eligible for? How can I maximize the government benefits that I get? Like this, that takes up quite a bit of time. I know, because I spend a lot of time on this kind of stuff. And I mean, but with that kind of thing, if I find some tax savings that save me $2,000 in taxes, I can apply that strategy every single year to save $2,000 in taxes. That's a lot less risky for me than me being like, oh, I think I can beat the market and earn $2,000 extra, right? Like, because I might beat it, or I probably won't. Most people do not. And so I actually would have been better off focusing my energy on doing things like optimizing my portfolio for taxes than speculating on investments. And one thing that when I ask Ed this question, what he thinks, if he has anything to add, what he said is that, yeah, he's definitely run into some investors, because again, he has his blog, he's got a podcast, YouTube channel. And so people comment on his content. And so he said there will be people that he talks to who call themselves index investors, like kind of implying that they're total market index investors, basically what I do, what I preach, what I do exclusively. So they'll call themselves that, but then he actually looks under a hood, he looks at their portfolios, again, and they are actually speculating on specific things. So they're like, oh, I think the US is going to do better, so they'll have almost all their investments in, let's say, US. Or they think, oh, emerging markets, I don't like it, so I'm just going to have nothing in that at all, right? So it's like they're basically being active. So you have to be honest with yourself and ask yourself, okay, by being active, am I actually beating the market? And then another thing that Ed added, which I thought was valuable, is that he says he's spoken to some Canadians where they will not even consider holding one ETF, because they will say, oh, it's one ETF, and so that's not diversification. How could I be diversified if I'm only holding one ETF? Well, this is basically just from a lack of education. So if you have something like an asset allocation ETF, that is essentially a basket of ETFs. So again, I'll use ZEQT as an example, since that's what I buy. So you've got ZEQT, and then within ZEQT, you will have ETFs within that ETF So some of them are to cover the US market. Some of them are to cover the Canadian market. Some of them are to cover the international market. So even though you're holding one ETF, that one ETF is basically a basket of ETFs. And some of those ETFs that are within that basket have literally thousands of stocks within it. Okay. So even though you're holding one ETF, that does not mean that you are not diversified. Asset allocation ETFs are actually extremely well diversified. And it's one of, I would argue, probably the easiest way to actually be diversified and also have your portfolio rebalanced automatically. So don't fall into that kind of thinking fallacy where one means you're not diversified because, well, no, hold on. Well, what is in that one thing? You know what I mean? Okay. The next thing on my checklist that I look at every year is, am I holding too much cash? Look at your checking accounts, look at your savings account. If you have quite a bit of money in there, what percentage are you getting on those? Because there is opportunity cost. There's a chance that you're probably not getting that much. And so you have to ask yourself, well, every dollar that I'm just keeping in my savings account or my checking account, that's $1 that could have potentially been invested and be earning me a lot more. So again, it is valuable to have some cash. I like to keep some cash on hand as well. But again, you do want to do this sort of analysis. I actually do it every quarter. So because every quarter dividends get paid out with the investments that I have. And so every quarter I have actually a reminder on my checklist to say, okay, evaluate, am I holding too much cash? And if I am, then it's time to invest because we want our money working for us. Like if you're in equities, the number that I typically use is 8%. And that's what a lot of financial planners use. So in that example, I would much rather get 8% than have it in some high interest savings account where I'm getting a really, really small portion of that. Okay. Now, again, there's the whole risk thing as well. Equities are obviously going to fluctuate. There's more volatility there versus a high interest savings account. So I'm not going to go into too much detail on that now because that's like a whole nother topic of how much cash do you hold versus equities. But bottom line is you do want to make sure you're not holding some obscene amount of cash because again, think of the opportunity cost, think of inflation that's eroding that cash. The inflation that's happening could actually be more than what the interest rate you're getting on that cash. So you're actually losing money over time. So again, just something to be really, really conscious of. Okay. The next item that I have is, do I need to rebalance? Are my weights off? Okay. So this is not an issue with asset allocation ETFs because they will automatically rebalance for you. So that's one of the reasons why I hold them in my RESP, because they automatically rebalance. It's very, very easy to do. I don't have to worry about that. I already have to worry about rebalancing my other accounts, so I don't want to have to worry about it within my RESP. But people use asset allocation ETFs for the retirement accounts all the time. And it's actually what I recommend for most people. Unless your portfolio is getting quite large, then you may want to consider buying the underlying ETFs. But I'm going to get into that a little bit later in the episode. So if you're completely new to this and you're not sure what rebalancing is, and when I say weights and you're not really sure what that is, basically what that means is you don't want too many eggs in one basket. So for example, let's say you've got money in the markets, market cap weighted, and then let's say the US has a really, really good year, okay, which it has lately. So let's say that happens. Well, now, because they've had an amazing year compared to everyone else, just because they've done so well compared to everyone else, your portfolio as a whole, now a larger portion of your portfolio is towards the US. So you're actually a bit less diversified. You're now a bit more concentrated in the US because what those investments are worth are a lot more now than they were in the beginning of the year before they started growing so much. And so what rebalancing does is it basically kind of shifts around your investments where, okay, if the US has had a really good year and someone else had a really bad year, okay, let's basically take some of the money from the one that's been performing very well and it puts it under the lower performing one so that your weights stay in balance so that you're still properly diversified. Because, if you don't want to have something where like 70% of your portfolio, I'm using an extreme example, but something like 70% of your portfolio is in the US, for example, right? That is way more than what they are worth on the worldwide scale. And so there you would basically, I would argue, be over concentrated in the US. So now you're basically incurring diversification risk on yourself. So that's just something that you do want to do. And again, I go into this in my course and how to do it yourself and how I rebalance. But if you have asset allocation ETFs, you don't even have to worry about that because they do it automatically for you. Okay. And actually, this is one of the reasons why I recommend asset allocation ETFs to friends and family, unless they're like super, super savvy when it comes to finances and spreadsheets and things like that, because most people don't want to rebalance. They don't want to deal with spreadsheets, things of that nature. And so that's why the asset allocation ETFs are a really good fit for most people. Okay. This next one is just specifically for people with their own corporations. Do I have RDTOH or CDA balances to clear out for your corporation? Again, if you don't have your own corporation, just don't worry about this. But this is something that you should be asking your accountant every single year. Do I have RTTOH and CDA balances to clear out. And I did want to give a big shout out to the Money Scope podcast with Mark Soth and Ben Felix, who have done an amazing job doing financial planning for Canadians, specifically when it comes to corporations. That's what that podcast is about. It's called Money Scope. So if you do have a corporation, here in Canada, I highly recommend you check it out because things get really complicated with corporations in Canada from an investment perspective, how to pay yourself, all of that. They did an absolutely amazing job on that podcast. I've been binge listening to it a lot over the holidays. Again, very, very highly recommended. But that was one of the things that I learned from listening to it, is that every year you should be asking your accountant that question if you have a corporation. All right, awesome. Moving forward. Can I put some money in my RRSP to lower me to the next tax bracket? So we covered this a little bit. Like, let's say you're $10,000 in your income, you're $10,000 into the next higher tax bracket. Well, maybe it makes sense to put that $10,000 into your RRSP so that your income drops by $10,000. You get to invest that money and you're not being taxed at that next higher bracket anymore. This is something that my wife and I did a lot back in our working years. Well, it's still something we do now. You should always be basically managing your tax brackets to see how can you be in the lowest one possible, depending on what you're earning. Okay. Next question you want to ask yourself every year is whether your TFSA is maxed out. And get ready to put in the new room starting January 1st and whatever else you're getting back from past withdrawals. So we touched on TFSA already a little bit. Basically, January 1st, you're going to get that new contribution room. So that's $7,000 for 2025. You're going to get that, plus you're going to get all that contribution room back that you took out the previous year. Okay, so basically get ready to max out again. TFSA is an extremely tax efficient vehicle to use. Highly, highly recommended. Again, people should be maxing out their RSP TFSA as much as possible. I would say FHSA as well if you qualify for it. So definitely, basically you want that on your radar. Most of you listening already know this, but again, it's good to have this checklist, good to have this reminder so that it's not like December of next year and you're like, whoops, I forgot to max out my TFSA. It's like, oh, well, you've had almost a whole year where your investments could have been growing tax-free, and instead that money was in some other, like let's say a taxable account where you're paying taxes on the dividends. So again, always have this top of mind. Okay, next question you want to ask yourself, can I put more towards equities? Am I being too conservative? So just again, kind of a self-reflection thing. So if you are, let's say, a 60-40 investor where you've got 60% equities, 40% bonds, ask yourself, okay, maybe am I being too conservative? Or do I really need to be like a 60-40 investor, 60% equities, 40% bonds, or else I'm going to get like panic attacks when the markets fluctuate. Some people are very panicky when it comes to market fluctuations. Keep in mind that long-term, there is a much higher expected return on equities versus bonds. And so I would argue, in my personal opinion, that you should be as high equities as possible that you can handle. Okay. And by handle, I mean that if we have, or when we have another major crash, when the markets fall, let's say 40%, when that happens, you need to be able to stay invested as opposed to freaking out and panic selling at the bottom or anywhere, or just basically, can you hold on to investments when there is a major financial storm, like a 40% drop in equities? That way I look at it is, what's the most that I can have in equities while still being able to not panic sell when the markets drop 40%? So that's the question that I think you should ask yourself. And if the answer is, oh yeah, I could actually, instead of 60-40, I think I can handle 80-20. Let's say that's your situation. Then, okay, maybe you should move the 80-20 in that case so that you have more in equities, because over the long term, there is a much higher expected return on equities than on bonds. Okay, next we've got asset location. So do I have the right investments in their most tax efficient accounts? And when I say accounts, I'm talking about things like FHSA, RSP, TFSA, people with corporations, they can have corporate investment accounts. Those are the things that we're talking about. And of course, there's also the taxable accounts. So these are also known as non-registered accounts. So the things that are outside your TFSA, outside your RSP, outside your FHSA. Okay. So for example, am I investing in a taxable account while I still have RSP and TFSA room? That's something that you really want to ask yourself. I'll say it again because it's really important. Am I investing in a taxable account while I still have RSP and TFSA room? So typically, you want to max out your RSP, your TFSA, as well as your FHSA if you're eligible before you start investing in your taxable account. Chances are, if you're listening to the show, you are eligible for RSP, TFSA. not everyone is eligible for FHSA. That has stricter rules. So check if you are. But basically, as a general rule, you should be investing in all of those and trying to max those out before you start investing in a taxable account, also known as a non-registered account. Makes sense logically. You want your investments to be tax sheltered if possible, instead of not tax sheltered. Okay, so just keep that in mind, because some people will not have those accounts maxed out and they're holding a bunch of money in a taxable account. So something, again, have on your checklist in terms of best practices so that you have things optimized. Okay, next. This is again on the subject, still on the subject of asset location. So which investments are you keeping in which account? So the next question I would ask myself is, am I holding bonds in my TFSA? Which I would argue as being inefficient, okay, in my opinion. Okay, so if you want bonds, that's fine. And most investors do want some bonds, but I only keep equities in my TFSA since those gains are tax-free and equities have a much higher expected return compared to bonds. Okay, so if you want bonds, that's fine, but I would argue don't have those bonds in your TFSA, because in your TFSA, you want the investments that have the highest expected returns, and bonds historically have underperformed relative to equities, also known as stocks. Okay, so for example, for most investors, I would argue, and then I mentioned this before, I'd argue that asset allocation ETFs are the best fit. In my opinion, it's what I recommend to friends and family and what I use in some of my accounts, like my RESP. So on this subject, you can do something like a ZEQT in your TFSA. Since that particular ETF, it's all equity. It does not have any bonds. It's index investing, buying equities across the entire world, okay? So you could do something like that, like ZEQT in your TFSA. And then if you want some bonds in your portfolio, you could do something more balanced in your other accounts, like your RSP, for example. So in your RSP, you could do something like ZGRO, which is ZGRO, or ZBAL, which is ZBAL. So those are, again, still asset allocation ETFs, still very low cost, still very good, but they actually have a bond component in them. And so the way that it works with asset allocation ETFs is, depending which one you pick, they're going to have a different mix between stocks and bonds. So ZEQT is the all equity one, where it's 100% equities and it is 0% bonds. ZGRO, so ZGRO, that has 80% stocks, 20% bonds. So again, it's more conservative than the ZEQT, which is 100% equities. And then we have something like ZBAL, ZBAL, which is the more balanced portfolio. And that one is 60% stocks, 40% bonds. And there are other ones as well that are more conservative, but this is just to give you an example. So there's a range of ETFs. And so what I'm saying is, in your TFSA, my suggestion or my opinion, you should have just all equity, so something like ZEQT. And then for that bond portion of your portfolio, you would pick the one that's most appropriate for you that has some bonds in it. And so that's what you would hold, for example, in your FHSA, or what you would hold in your RSP especially. So this way, you're still making investing super easy by just buying two types of asset allocation ETFs, an all equity one and one that has equities but also bonds. But when you're doing this, you're also optimizing them a little bit by having the highest expected growth investments, so the all equity ETF, in your TFSA, while having the more conservative investments, in this case, in your RRSP. Okay? Because again, when you take money out of your TFSA, any growth within that is tax-free. And so obviously you want the things that are going to grow the most in your TFSA, because you get to withdraw that tax-free. Whereas with the RRSP, when you take that out, that's going to count as regular income. So that is something, again, to ask yourself when it comes to what ETFs do I want to hold in each account. Okay, next we get into taxable accounts. So this is, like I said, you've got your FHSA, you've got your RSP, you've got your TFSA. Those are your registered accounts. And then there are your non-registered account or non-registered accounts, also known as taxable accounts. So these are the non-tax sheltered ones. So with this one, you should ask yourself, should I not have any Canadian dividends in that at all? Okay. Now, I'm going to explain that in just one second, but typically, just at a higher level, you want to max out your RRSP, TFSA, and FHSA first before investing in taxable accounts. But if you are maxed out in those accounts, then your next step is to invest in a taxable account. So you've used up all your contribution room in the registered accounts. You can't add any more money into that. And so now you're basically forced to put money into the taxable account. Now, typically, if you want to retire at an early age, then this is the path that you end up taking. That's what we did, because there basically isn't enough room in your TFSA and RSP and FHSA to live off of if you're retiring in your 30s, like what we did, for example. So you basically have to start investing in a taxable account if you're doing the whole FIRE thing, the financial independence, retire early, where instead of waiting till, let's say, 65 to retire, you're retiring in your 30s or 40s, that kind of a thing. So this is just something, again, to have on your radar if you are part of the FIRE crowd, like what I am, where you are doing the whole early retirement thing. Okay? Just realize that you are basically going to have to put money into your taxable accounts realistically in order to make your portfolio large enough so that you could actually retire early. Okay. So when you're doing this, when you are investing in taxable accounts, this is where dividends can actually start hurting you, especially Canadian dividends. Now, this can be a little counterintuitive at first, because if you've ever looked into how dividends from Canadian companies are taxed in non-registered accounts, then you'll know that Canadian dividends can actually be extremely tax efficient in non-registered accounts, because when you receive those dividends in a non-registered account specifically, you end up getting what's called a dividend tax credit. So depending on the tax bracket that you are in, especially if you're in a low tax bracket, the tax that you pay on those Canadian dividends from these Canadian companies, it can actually be the tax you pay on it can actually be extremely little due to that dividend tax credit that you automatically receive when you do your taxes. And so for the majority of Canadians, if your TFSA, RSP, and FHSA are maxed out, then like I said, the next step is to invest in your non-registered account. And so when you put money to invest into that account, it is typically advantageous from a tax perspective to hold your Canadian equities, so your Canadian stock ETF, in that non-registered account to make those dividends extremely tax efficient. So for example, if you were trying to optimize at this level, so instead of buying an asset allocation ETF, you're buying underlying ETFs. So then for the Canadian one, you would get something like ZCN, which is basically you're buying the Canadian index in terms of equities. Now, there is a caveat when it comes to this. If you are receiving income-tested government benefits, like the Canada Child Benefit, so the CCB, or the Guaranteed Income Supplement, GIS. So I'll cover that in a few minutes. Now, apart from that caveat, Canadian dividends are extremely tax efficient in non-registered accounts. But of course, you want to ensure that your investment portfolio is still in balance. In other words, that you are properly diversified internationally. For example, you don't want half of your investment portfolio to just be in Canadian equities, as now you are basically putting too many eggs in one basket. Instead, you want an internationally diversified portfolio. So again, just because Canadian dividends are extremely efficient in a taxable account, that does not mean that your entire portfolio or that every single investment that you have in your taxable account should only be Canadian equities. Because if you do that, if you follow that rule for yourself, you might end up being way overweight in Canadian equities. And just as a caveat, if you want to know what weights to use, in other words, how much to put into US equities versus Canadian equities versus international equities, well, what I personally do is I use the weights that the asset allocation ETFs use. So for example, you can look up the holdings for ZEQT, which is, again, excellent diversified asset allocation ETF that I personally use. And that ETF will show you the split between the different geographies. Now, you could just buy ZEQT to keep things simple, because then you don't have to worry about how much to put into each geography, because ZEQT will automatically hold all those equities across the world for you in the correct amounts, and it will rebalance it for you to make sure that you are never overweight or underweight in any particular geography as the market moves up and down. So it's super convenient, and I would argue that using asset allocation ETFs like ZEQT is the correct option for most Canadians, like I've mentioned earlier. But if instead you choose to buy individual ETFs for each geography and put them in the most tax-efficient accounts, which is a lot more work but can be a bit more tax-efficient, assuming you do it properly, then in this example, we would instead take a Canadian equity ETF like ZCN and make sure that this ETF is in our non-registered account so that we can get that dividend tax credit. Then you can, for example, put your US and other international equities into your RRSP and TFSA. US equities, by the way, can be more efficient in your RRSP, assuming you are buying US listed ETFs in US currency. But to pull that off successfully, it gets even more complicated, because then you should be using a more advanced technique called Norbert's Gambit to efficiently do the currency conversion. And frankly, it's a lot more work and probably not worth it for the tax savings unless you have a fairly large investment portfolio. If you want to learn more about that, just Google Build Wealth Canada, Norbert's Gambit, and that will take you to a blog that I wrote on my site that explains how to do it. Okay. So you've probably noticed we're getting into more intermediate, advanced level things with these tax optimization strategies. And again, I want to stress that you don't have to take it to this extreme level of tax efficiency and optimization where you are buying a different ETF for each geography. So one for Canada, one for US, one for international developed, one for emerging markets, and maybe one for bonds. So you don't have to do it to that level where you're buying individual ETFs instead of an asset allocation ETF and then putting those individual ETFs in the most tax efficient account. So the RSP, TFSA, non-registered FHSA, doing things to this level really complicates things. It's a lot of work. I know because I do it myself. And I would argue that it's really not worth your time to do unless you have a fairly large investment portfolio. And even then, I know Canadians that have large portfolios, are financially independent, and they still just use a single asset allocation ETF like the ZEQT I mentioned, for example, because it makes investing so much easier because you don't have to rebalance and things are just much more automated. So if your portfolio, I would say, is less than, let's say, $300,000, give or take, then honestly, I wouldn't even consider buying different ETFs for each geography and putting them in the right accounts and rebalancing annually, because the little amount of money that you'll save at a portfolio of that size, so again, I'm using $300,000 as kind of like a litmus test, so to speak, it's probably not worth your time to do that level of extra work and analysis and learning just to save that little bit of extra money. Instead, in those cases, I would say if you're under 300,000, just buy an asset allocation ETF like the ZEQT and you're done. Then once your portfolio is larger at, let's say, $300,000 or more, then decide if you want to dive into this extra level of complexity. If you want to go down that rabbit hole, start researching it, and then decide whether you want that extra bit of tax efficiency in exchange for a lot more complexity and a lot more work compared to just buying an asset allocation ETF. Okay, so go down that rabbit hole once your portfolio is $300,000 plus, is what I would say. Okay, and this is really because the savings that you get, it's essentially a percentage of your portfolio. So if your portfolio is $100, then you're putting hours and hours and hours of work learning this, optimizing all of that to get a percentage amount. But on $100, that's nothing. It's not worth your time. It's like you're getting paid less than minimum wage. Versus if your portfolio is $1 million, okay, or several million, okay, well now even a percent of a percent is actually a fair bit of money once you apply it, right? So this is why I say you want your portfolio to be large enough so that if you look at, okay, how much time am I spending on this? Okay, so what is my hourly rate, essentially? How much extra money am I getting in tax savings for all the hours that I'm getting? And so if you do it at a small portfolio, you're basically working for less than minimum wage even. So that's why I say 300, give or take, is kind of the benchmark I would use when you want to start evaluating this. Okay, so full disclosure, I do it to this complex of a level where I do this whole asset location thing. And again, I do it because our portfolio is now large enough where it's worth my time and I don't mind the complexity. And I'm a giant money nerd, so I actually enjoy this for some strange reason, okay? But even for me, for things like my RESP, which I mentioned before, which should be viewed as its own separate portfolio because that's for my kids' education, in that account, like I said before, I just use ZEQT, which is the asset allocation ETF. I use that exclusively these days just to keep things simple and to not have to worry about rebalancing that portfolio too, okay? Just dealing with rebalancing in my retirement accounts is enough for me. I don't want any more than that. All right. So even in my corporate investment account, I actually have some ZEQT in there as well, because again, even though Canadian equities are tax efficient in a corporate investment account, you generally don't want your entire account to just be one ETF of Canadian equities, for example. So I do hold some ZEQ in there as well to have some balance so that I stay at the proper weights and so that I don't only have Canadian equities in my corporate investment account. Again, with corporate investing, that's like a whole nother animal. So like I mentioned, check out Mark Soth and Ben Felix's podcast, Money School podcast. If that applies to you, they go very much into the weeds. It's unbelievable. If you're into this stuff like me, definitely recommend it. But again, to warn you, it is complicated just because of the whole nature of corporate taxation in Canada. And if you don't have your own corporation, then you don't have to worry about it. So moving on. Now, if you want some more details on the ETFs that I buy and why, both asset allocation ETFs and individual ETFs by geography, then what I actually did is I created an updated guide that goes into that in a lot more detail. So you can get free access to it by going to buildwealthcanada.com buildwealthcanada.ca/guide. So that's buildwealthcanada.ca/guide. Just put your email in there and basically I'll email you the guide. It's actually a live Google Doc that I keep updating as things change in the ETF market. So it's always the most up-to-date document on what I invest in and why, and what I recommend basically to friends and family. And I've actually recently updated for the year 2025. So it's all up to date and ready for you. And I'm going to keep updating it as well as things go on. And once you enter your email to get the guide, you'll also get my email too when I send you the guide. And so if something is unclear to you while you're going through the guide, you can send me an email and I'll be happy to clarify it in more detail in the guide for you. So that because if you have a question, chances are there's other people reading the guide that also have that question. And so then I can basically explain that one thing in more detail so that it's more clear for everyone. So that way, everyone benefits in the community instead of just you. So again, something is not clear, just let me know. I will be glad to clear it up. But I try to make it as clear as possible. So again, that link is buildwealthcanada.ca/guide. It's completely free. Enjoy. And also, I like it too because it's transparent, because then you actually know what I invest in and why and that kind of thing. Okay. The last thing that I'll mention is that caveat that I brought up earlier, that if you are holding Canadian equities in your taxable account, then you are getting dividends paid out to you. And like I said earlier, this can be very tax efficient due to the dividend tax credit that you receive. However, if you are receiving income-tested government benefits like the Canada Child Benefit, which is the CCB, or something like the GIS, which is the Guaranteed Income Supplement for retired Canadians, then those can actually start getting clawed back at lower income levels if you are receiving dividends from Canadian companies. And this is because of what's called a gross up that exists on Canadian dividends in taxable accounts. So, in other words, while Canadian dividends are amazing in taxable accounts, if you are not receiving benefits like CCB or GIS from the government, that benefit that you get from Canadian dividends in your taxable accounts are drastically reduced if you are receiving these benefits. Now, it might still be worth it depending on multiple factors. And so this is something that I suggest you get your accountant to crunch the numbers on for your specific situation if this applies to you, where you've maxed out your TFSA, you've maxed out your RSP, you've maxed out your FHSA if you're eligible. So now you have to invest in your taxable accounts. And now you're debating, okay, should I actually be putting in there because I don't want to get clawed back on my Canada Child Benefit, or I don't want to get clawed back on GIS. So that, once you reach that level, well, first of all, congratulations for maxing out all your registered accounts. That's an awesome accomplishment. But now, as a present, as a reward for doing so good and investing so much and saving so much, now you get to enter this new world of added complexity of investing in taxable accounts. So again, meet with your accountant about this, have them crunch the numbers for you, because what is optimum for me might not be optimum for you. So when I crunched this with my account, for example, the conclusion was that even with the gross up, I was still better off having Canadian equities on my taxable account instead of international equities where there is some withholding tax and there's no dividend tax credit. So in my case, because of all the different credits and different tax things that I receive, it was actually worth it. But I remember when I crunched my own numbers without factoring in some of the credits and the other things that my account knows about me, if I just did like a more basic thing in a spreadsheet, the conclusion was that I would actually be better off doing international equities in my taxable account. So it's very interesting. So I actually came up with a different conclusion than my accountant, just because his tax software had all these different tax credits that we're eligible for. It had our entire financial picture versus just my financial spreadsheet where I'm just calculating things in a vacuum. So I'm just saying this, that instead of taking just general advice and thinking, oh, this is the rule and this applies to everyone no matter what, that's not the case, at least from my experience. Once you're at this level where your tax sheltered accounts are maxed out and you're investing in taxable accounts, okay, that means you actually have quite a bit of money. Okay. And so at that point, I really do think it makes sense. Like if you've been DIYing your own taxes and all that, okay, awesome for all these years. But at that point, it's like, okay, at least pay an expert accountant or fee-for-service financial planner for their advice to crunch numbers for you to see what is the optimum thing for you for your particular situation. It is worth it because, the differences can be in the thousands. So even if you pay them a few grand, if they're going to save you 10 grand plus over the course of your lifetime by figuring out what's optimum for you, that is a really good return on your investment in terms of money that you're paying them to help you find these optimizations. Okay. So this topic, when it comes to the clawbacks that exist with GIS, with CCB, Again, this is a more advanced topic that applies to a relatively small portion of the podcast audience, I would think, and definitely a small portion of the Canadian population as a whole, since most Canadians do not have their RSP, TFSA, and FHSA all maxed out, okay? So that should be the priority. Max those out first. Don't even worry about this big complicated thing yet. Then, if you're maxed out and are now investing in taxable, also known as non-registered accounts, then this is something to know if you're going to place Canadian equities in your taxable account. So in the guide, I go into more detail about this and I explain how I tackle it myself. And like I mentioned earlier, you can go to buildwealthcanada.ca/guide and you can get it for free, where you see what I invest in and why. And in that guide, I also touch on the subject of, okay, I have 2 kids, so we are getting CCB. And so I want to maximize that. I want to minimize the clawbacks. So what are some strategies that I use to try to make that clawback as little as possible? So I go into that in the guide as well, okay? So again, buildwealthcanada.ca/guide, and that's where you can see what I invest in, why, and these different analysis when it comes to this particular subject as well. All right, so that is it for the episode. It's been a while since I did a solo one, but I think this is a very critical thing to do once a year. Now you've got a checklist that you can actually go through yourself for your own finances. Again, I encourage you to do it January, February of the year. If you're listening to this and it's still December, then in particular, focus on those December 31st deadline items that I mentioned in the very beginning. And if it's past December and you're listening to this, well, still listen to that part of the episode, because those things also apply to December of 2025 and onward. So this way you know what's coming and you can start thinking about it ahead of time to make sure that you hit those deadlines and that you're factoring everything in. All right, I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well. I'd like to end with a big thanks to one of our sponsors who, apart from my investing course, literally keeps the entire Build Wealth Canada podcast and website free for you. Do you know why asset allocation ETFs have become so popular? Asset allocation explains over 90% of the variation in a portfolio's quarterly return. So it's no wonder Canadian investors are turning to these ETFs. Today's sponsor, BMO ETFs, offers these innovative all-in-one solutions with the BMO All Equity ETF, ZEQT, the BMO Growth ETF, ZGRO, the BMO Balanced ETF, ZBAL, and the BMO Conservative ETF, ZCON, and many more. BMO developed these to help provide investors with ETFs that offer broad diversification and are also low cost and simple to use. These ETFs invest in a number of underlying index-based ETFs and are rebalanced automatically back to your set asset allocation or mix of stocks and bonds. They offer a hands-free approach to investing that is built on disciplined weights to provide exposure to different geographies and sectors all in one solution. BMO actually offers 8 asset allocation ETFs, and you can learn more at bmoetfs.com.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.